Hi, I'm Max Keiser. This is the Keiser Report. Everything's going to plan. Let's check in with Stacy.
Max, full disclosure, the first headline is actually from you. It's a tweet from you. What's happening with GME today shows maintaining fair and orderly markets becoming a nightmare. Market-making technology across all markets globally is breaking down. The direct result of central banks' ZIRP price discovery across all markets is shot to heck. And this is referring to one of these stocks out there called GameStop. GME was the symbol, or is the symbol. GameStop, yeah, you're seeing that correctly. Currently 47% on 2.5 million shares of pre-market volume. It was $20 just 2 weeks ago. No, there's no fundamental news behind that kind of move. So it was up to $100. It was like up 45%. Over 45% in the pre-market in just one day, 50% the day before. So on no news other than some Reddit forum boards like pump and dumping.
Right, so this is wildly fluctuating, and the Securities and Exchange Commission had to halt trading on this particular item. Last I checked, 5 times in a single day. And the volume is greater than traded on the proxy for the market itself, the S&P SPY, I guess, is the ETF that trades the market itself. There's more volume in this particular issue. Strangely, and I don't think I've ever seen this, both the calls and the puts were trading up, right? So that shows clearly, uncategorically, that market making and price discovery is completely broken. Now, you could say it's only in this particular issue, but that's not true. It's really rampant across all markets: stocks, bonds, commodities, currencies. Everywhere you look in the world, you have price discovery is broken. And the ability to make markets has been shattered because access to free money is now ubiquitous and virtually infinite. And so the ability to create a fair and orderly market, which is what the law suggests is required in this case, is overwhelmed by an avalanche of day traders and Robinhood traders and cheap money. And it goes directly to the doorstep of the Federal Reserve Bank and other central banks around the world that have allowed this to happen. Now, up until 1971, there were 2 ways you could anchor a market, and that would be either making a reference to gold or making a reference to interest rates. Now, starting in 1971, gold was taken off the table. No more reference to gold in the currency markets, and therefore no more reference to gold in any market. It was all fiat, referring to other fiat, relying on the U.S. and the U.S. dollar to be the ultimate reference currency. However, and leaving interest rates to be, or interest rate differentials to be the anchor that is girding the underlying foundation of these global markets. But starting with 0% interest rates that got down to 0 under Bernanke and have gone negative under Janet Yellen, there is no anchor whatsoever for pricing any of these markets at all. So it's purely what I call the murmurations, the starlings in the sky that are trading in patterns that are based purely on, well, nobody knows exactly why the murmurations trade the way they do. But this is really concerning because it shows that free market capitalism, as we understand that term today in 2021, is officially bust.
Well, that's really important for the next segment that we're going to get into in terms of China overtaking the United States in terms of foreign direct investment, partly, I think, because of the bustness of, capitalism. But, you mentioned the options, and Max used to be an options trader when he worked on Wall Street, but you also invented the virtual specialist technology, which is market-making technology and price discovery technology. So what do you mean? Why is it unusual for the volume of both puts and calls going up?
Well, the price for them to go up simultaneously indicates a complete breakdown in price discovery, because a call is a bet on a security rising in price, and a put is a bet on security falling in price.
Oh, I get it.
So if both puts and calls are going up simultaneously, it means that the market makers in the options markets are patently defrauding everybody in that market. So whoever's trading those, let's say in the Chicago Board of Options Exchange or any of the other major options exchanges, they're defrauding people. The connection between the stock market, which is the reference for those options, those market makers are also committing fraud. And the result is a retail environment, a lot of Robinhood traders that are trading if it were a video game, the standards for Grand Theft Auto, the video game, are higher than those by the SEC and the CFTC and FinCEN when they are supposedly regulating the stocks that reference the companies that make the video games. I know from the Hollywood Stock Exchange that when I made it the technology to achieve verisimilitude with the actual exchanges, my board of directors was concerned that there was too much wiggle room in this price discovery, and I had to explain to them that that's the way it works on these exchanges. The standard is lower than you would expect in some of these games, but this is remarkable in that the market, the capitalist model running the free world, is in now, I would say, and to use a video game. It's gone tilt. If you're playing pinball, that's it, pinball from the 1970s. It would be tilt, tilt, tilt. It's done, it's toast.
Just to show you the hyperinflationary nature of the chaos in the markets that's going on as you talk about the central banks pushing people into irrational behavior. Well, GameStop has quintupled this year. This is the chart of its revenue and net income over the last 10 years. As you see, its revenue is actually down over the last 10 years, where its income is flat.
Right. Well, I'll tell you, last time we saw this in history was 1920s. So 1920s, the roaring 20s in the New York Stock Exchange in New York, in America, you had almost no regulations, and gangs of bankers would gang up on stocks and push the price around, and it would all be trading on inside information, and they had a great credit line with each other. And then you had the crash. And then you had the Securities Act of 33 and 34, and you had a lot of regulations. And then starting with Ronald Reagan and Greenspan and continuing through each successive administration, those regulations were peeled away. And we're now right back to the 1920s, except the leverage is a lot higher. So, and of course, in the 20s, you could buy a stock with 10% down, and that was raised under the new regulations to 50% down. But using derivatives and options, you really don't have to you can put less than 1/10 of 1% down to control a stock or a security. So this is going to end like the 1929 crash is going to look really, really tame compared to what's going to happen.
I also want to point out that, you mentioned the 1920s, and there were a lot of blank check stock companies then, and that's an explosion so far this year. Just in January, since 2021, since the new year, we have something like 310 SPACs listed on the New York Stock Exchange versus something like 150 of all of last year, which was the beginning of this insanity. So explain what that has to do with a potential crash.
Right. Like in the 1920s, bankers on Wall Street decided to do blank check companies where they would raise a bunch of money first and then figure out what to do with the money second. It's completely the opposite of what you'd expect, where a company builds a business and then to go get some more capital to expand their business, they go public on an exchange. But they have to have a business before they go and raise the extra money. Here you raise the money first and then figure out what the business is. And SPACs, as they're called, it's an explosion. And it's being bought by other SPAC owners who are buying SPACs in other SPACs, and it'll be listed as an ETF, which is a derivative of more SPACs. So it's a layered Ponzi scheme that, again, the leverage is probably 100 times or more than it was in the 1920s.
This is kind of a good analogy for the final headline here about China, because since 2001, we've had a blank check economic policy. Like, we sent all our manufacturing to China, and with the proviso that we'd figure out what to do one day when we no longer had wealth creation. It's obvious. It's just all this casino gulag state, right? We just gambling on if you happen to get in. I mean, if you got into GME and made quintuple in 2 weeks, you're lucky, right? It's just random and arbitrary who becomes wealthy, because it was nothing to do with their income or revenue. It was just like you happened to be in the right stock at the right time.
It's an interesting arbitrary wealth would undermine moral values.
Yes.
That's feeding the social unrest because there are these daily lucky winners in the global gulag casino that is American capitalism. And if you happen to hit this stock and quintuple your money, then and you're next door and you didn't, and there's no way to morally, through hard work and perseverance, to achieve success, it's purely the casino gulag, you're going to be resentful. And those resentfulness can become anger.
And then at this point, we have this, like 20 years later. So yeah, in 2001, we saw China enter the WTO. And now China overtakes U.S. as world's leading destination for foreign direct investment. As China's recovery gains steam, foreign companies move to pour more money into China, viewing the country as a production base and as a critical growth market. So new investments by overseas businesses into the U.S., which for decades held the #1 spot, fell by 49% in 2020, according to UN figures released Sunday, as the country struggled to curb the spread of the new coronavirus and economic output slumped. Of course, we've been warning about this. We're having this Thucydides trap. Biden is sending, more aircraft carriers and stuff over there between the China-Taiwan Straits. And also, we have that great reset. And this is the UN calling that China is now the #1 for foreign direct investment. It's the Great Reset and World Economic Forum. We also had Davos, and President Xi opened that event this year. So, I mean, there's interesting times coming. And in terms of the put call options on which one wins, where do you think that price is going, Max?
Yeah, this is what I think. I agree with Christine Lagarde, who recently warned there's only one escape valve, and that's Bitcoin. Because even the price discovery in gold is subject to the same hyper-financialization and casino gulag pricing model as we see everywhere else. So gold's not a good barometer.
Yes, because it was recently revealed that, and I think Lawrence Lepard mentioned it, 321 times. There's 321 times paper versus gold production actually in a year. So that's as crazy as GameStop.
Right. That's why gold is not participating, and Bitcoin is blowing the whistle. And Michael Saylor, by the way, who's bought billions of dollars worth of Bitcoin, recently came out publicly and told the regulators that, and he used some very colorful language, where they could go. That he is unconfiscatable with his Bitcoin, and the game is over. So every corporation in America now is going to do the same thing. Hello, $500,000 Bitcoin. We're going to take a break. When we come back, much more coming your way. Welcome back to the Keiser Report. I'm Max Keiser. Time now to return to our conversation with Lawrence Lepard. He's the investment manager over there at Equity Management Associates. Lawrence, welcome back.
Thank you, Max.
So a lot of institutional money is moving into Bitcoin right now. You've got the endowments at Harvard, Yale, and Princeton moving into this. You've got corporate treasuries moving into this. Hedge funds are into it. What do you see?
See the same thing. I mean, Michael Saylor, smart guys. Paul Tudor Jones, it's the fastest horse in the race. I mean, there's just a lot of guys who are figuring it out. And once you do figure it out, you can't come to any conclusion other than the fact that it is a superior form of money. It will be the hardest money ever on a stock to flow basis. And, you've got a beautiful thing going on there with that technological innovation. And then you've also got the adoption curve. I mean, we're about the 10% point where it's about to bend and go up. And I have this curve in my quarterly report, and you can just see that, it's going to widely spread. And I like to say everybody's going to own Bitcoin. The only issue is at what price. And so I'm happy to own it now in advance of everyone else wanting some.
You've got Citibank and Bank of America with price targets between 100,000 and 600,000. You recently said on our show that you are looking for a short-term target of 60,000. What's the price action in 2021 look like for you?
I don't know exactly where it goes. It could be 200 max. It's certainly going to be 100. If you kind of look at the typical pattern off a base, it'll do an 8 to 10x, and call the base 10,000. So I mean, I think 100 is easy, and the base is moving up on the moving average basis. I like to look at the 200-day moving average. I mean, it's an absolute no-brainer to buy it below that. And when it gets extended above that, you can either stop buying or maybe, sell a little and prepare to average down when it comes back in. It is volatile, we all know.
Right. Well, that's the history of money, is that it's starts off as a
Right.
collectible, moves into a store of value, becomes a medium of exchange, and then a unit of account. So we're still at the store of value phase. I agree that once it gets over 100,000 or so, you'll start to see people actually use it to buy stuff like houses and cars and
Oh yeah.
yachts and small countries and islands, and things like that. So,
Plateau, right.
yeah, absolutely. Now you've got. Let me talk about gold and silver for a second. So you are very constructive on gold and silver, as I understand it. This idea from some people that Bitcoin will completely demonetize gold. I'm not totally on board with that. What do you think?
Maybe in a 50-year time frame it might, but certainly in the shorter time frame, you got 6 billion people who understand gold, and you don't have 6 billion people who understand Bitcoin. And you've also got, the issue here, and it really pains me when I see Bitcoin people hammer gold people, or when I see gold people hammer Bitcoin people, because we're all on the same team. We're trying to go to a sound money standard to prevent the fiat excess and the criminality of the system that we now live in. And so they both need to win, and they both will win. There's $400 trillion of financial assets in the world. All the stocks, bonds, cash, everywhere. It's $400 trillion. There's less than $5 trillion of gold and Bitcoin. So, think of, there's plenty to go around. Bitcoin's the fastest horse in the race, but it's volatile. Gold is slower, in terms of speed. The IRR on gold has sucked, in part because it's been, manipulated, but, it could catch up quickly if we do a reset. And my opinion is that, they'll both benefit hugely, and not having one of the two of them will be an enormous mistake. I like to have both. I probably have a, kind of a 70-30 weighting, gold, Bitcoin. And, I think they're both going to work. Longer term, Bitcoin's got some real advantages. It's got some drawbacks as well, but I think it's got some advantages.
Are we in the early stages of a new commodities bull market?
Oh, absolutely. Look at the charts. It's some of this could be supply related to COVID, but that's all it takes. One thing I would recommend that your listeners go and listen to is the Paul Singer interview by Grant Williams. He's a very successful and intelligent money manager, and he is absolutely convinced that he said, I think the one thing that everybody is missing is the threat of a tremendous inflation surprise. And I would have to agree. You think of these modern monetary people and the expenses, the way people are spending money in the government. I just don't think there's any doubt they're going to keep pushing it until they get inflation. And then they're going to have way too much inflation, because inflation's like being pregnant. You can't have a little. So, the commodities are reflecting it, right?
So it's back to the 1970s style. You've got inflation or stagflation. The economy certainly is stagnating because of the COVID crisis. And if all that money printing comes around, you do have inflation. I heard the Paul Singer interview. He's an interesting guy. He doesn't like Bitcoin, by the way. But
Yeah,
he's calling for some inflation to come around. It seems to me that one of the issues is that for 20 years, starting with the Clinton administration, the world economy was opened up to allow America to export its inflation to China. But now China is the new dominant country, right? So they're not working for cheap wages anymore. They're leading the world. So there's no place to export that inflation. So it gets trapped inside the U.S. economy, and we start seeing prices for stuff really go up.
Right. Well, and you're going to see money coming back here as people realize the dollar's losing value. All those dollars that are overseas are going to come back here. And it's going to be a slightly different inflation than the 1970s style inflation. That was driven by the Arab oil embargo and by power of labor unions and by demand. This is going to be currency substitution inflation. In this particular case, what's going to happen is people are just going to look at the dollar and say, this thing's not holding value. I know it's not. I need to own real assets. This government's out of control. If you study all the hyperinflation facts, and I know you have, the tipping point comes when people realize the policies are such that they can never turn back. That the policies, they will have to print forever. And because it's a Ponzi, they will have to print in ever increasing amounts. And when that happens, as you pointed out earlier, things can move very quickly. And they will. The bond market is going to revolt. And, you see average people saying, okay, sell me that house. I don't care if it's if I have to pay a premium to ask. I want that house now because I can lever it and borrow at 3%. And that's a good deal.
Yeah, absolutely. And the weirdness of it all is that the average person is communicated to in such a way that you would have to make the case that financial news, as it's spoon-fed to the American population and the global population, is just outright propaganda, Lawrence.
There's no question, and a lot of people already realize that, and you can see it with their voting patterns and other things. I mean, the problem the elites have is there are a lot more of us than them. They control a lot of the levers, but people are waking up, and you can only pee on somebody's leg and say it's raining for so long, and people are very angry. I mean, I'm frustrated that unfortunately not all of them know exactly how and where to direct their anger. The sound money thing is the basis of all of our problems. I mean, in my opinion, it really is.
Yeah, absolutely. We've been talking about it. You've been talking about it. You need to have sound money to build a sound economy with sound values, et cetera. So even the founders of the United States realized that, and they made a big issue of it. And this was a theme throughout the creation of the United States as we know it. Now, let me ask you this. So you mentioned Michael Saylor in a previous interview. He's become not only a buyer of Bitcoin for the treasury of his company, MicroStrategy, but he's become, a bit of an activist. He says publicly that he could put untold billions of Bitcoin onto his seed phrase Mind Wallet, and there's absolutely nothing the government can do about it. Is he just is he the Chuck Norris of Bitcoin?
No, you're the Chuck Norris next. He's definitely one of the godfathers. He's not an OG either. I mean, he only got on it late, but he's certainly got a lot of capital to throw around. And the government can try and do a lot of things. I don't think they can stop it. This horse is out of the barn. And, I mean, it's our federal bureaucrats against a bunch of, strong-willed, super intelligent, technology savvy people. And, in that bet, which side am I going to take? I know who I'm taking. We win. There's little doubt in my mind. I mean, we're at the stage right now. We're at the Gandhian stage where they're arguing with you. They ignored it. Now they're arguing with us. The next stage is we win.
The thing about Michael Saylor, in my view, is that he is not going out on a limb. He has done his homework. He has done the research. He's looked into the numbers, and he knows he's 100% guaranteed to come out on the winning side of this asymmetric bet that the regulators are 100% guaranteed to lose. The central banks are going to lose as night follows day. As there exists the 2 + 2 = 4. He's not going out on a limb here. He's just stating an obvious fact, and the fact that these regulators don't want to even entertain thinking about it is exactly the problem, because they've been in power for so long. They've never been challenged. It's collusion. They collude with each other globally. It's a cozy little club. And someone just threw a stick of dynamite in there, and it's blowing up in their face, and they have no idea what to do, Lawrence.
No, that's absolutely right. And it goes further than that. I mean, I look at a guy like Paul Singer, who I respect because he's an intelligent, good money manager. But, there's some people in my generation and other generations who just haven't taken the time to really understand what it is. They don't understand the difficulty adjustment. They don't understand all of the issues surrounding Bitcoin and how it operates. I mean, it's really an ingenious system. And, it's almost like divinely given. And so in my opinion, it's not that risky a bet. I mean, it's risky. What I get frustrated about sometimes when people try and shove others into it and don't make them aware of the volatility, because nothing worse than to buy a rip and then, say, oh, I was wrong on the dip and get blown out of it. You've got to actually take a long-term perspective. And I just think it's irresponsible when people are pumping it without making people aware of the ups and downs. Because, I bought some at 300, I bought some at 1,000, I was buying at 17,000, then it went back down to 3,500, and I doubled down. I mean, it's got volatility. It definitely does. And that's an issue, but you would expect something that's in the process of becoming the new numeraire is going to be volatile. We're trying to put the ocean into a swimming pool. I mean, it's going to be a volatile asset for a while, but that'll calm down over time in my estimation.
Absolutely. Well said. The thing about it is that with paper money, you are guaranteed without any equivocation to lose purchasing power. And
Absolutely.
That's been proven for 300 years. With Bitcoin, you're guaranteed to see the price go up. Guaranteed the price goes up.
Right.
So are you willing to accept a little short-term volatility, or would you rather have something like fiat money where you're guaranteed to lose purchasing power? So that's the trade-off. And the volatility is over the medium term disappears, right? Pretty much. It's
Yeah.
only on a short-term thing. But to your point, yeah, it's annoying if you're buying a high and you see it, take 3 or 4 months to recover. There's ways to mitigate that risk through dollar cost averaging and things like that. But
That's what I do.
nevertheless, so I think that the percentage of portfolio managers out there who are going to start allocating to Bitcoin is going to go from under 1 or 2% right now to darn near everybody, right?
It's going to be wild because it's going to get to the point. I mean, you look at how many coins there are. You look at how many billionaires and millionaires there are. You look at how many assets there are in the world. I mean, owning one coin, all my kids have got one coin that I bought for them at much lower price. Owning one coin is going to be a big deal in 10 years, 20 years. I mean, it's going to be a really big deal.
All right,
And
Lawrence Lepard, we got to go. Thanks so much for being on Keiser Report.
Thanks, Max. Really enjoyed it.
All righty. And that's going to do it for this edition of Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank our guest, Lawrence Lepard, and he's over there at Equity Management Associates. Until next time, bye, y'all.